My friends, people often come up to me and ask the same question again and again. Warren, why are you sitting on all that cash? Why not put it to work? They see the headlines. They know that Berkshire Hathaway has more than $150 billion parked in treasury bills. And to many people, that seems like a mistake. They think it's unproductive, that we've lost our appetite for investing, or that we've suddenly become timid. After all, inflation eats away at cash. It looks strange to them that an investor who built a lifetime reputation on finding great businesses would rather hold paper, earning a few percent a year. But what seems puzzling to some people is actually a clear expression of the philosophy that has guided me and Charlie Munger for decades. We are not afraid, we are patient. And patience in investing is often the highest form of action. You see, the world rewards activity. Brokers earn commissions when you trade. Fund managers are paid for appearing busy. Television commentators fill the air with talk about what's happening in the markets every second. In a culture that prizes constant motion, doing nothing feels almost unnatural. Yet in the world of investing, inactivity can be one of the most powerful disciplines. When the odds are not in your favor, when prices are too high, or when the future return doesn't compensate for the risk, the right thing to do is to wait. It's not glamorous, but it's effective. The market is designed to tempt you into action, but the secret of success lies in selective inaction. I like to compare investing to baseball because the analogy fits perfectly. In baseball, if you let 3 good pitches go by, you're out. In investing, there are no called strikes. You can stand there all day, all month, or all year, and the market will keep pitching you opportunities. You can wait for the one that comes right down the middle, the one that's easy to understand and fairly priced. That's what we do. Most of the pitches are outside our zone. Some are wonderful companies at prices that make no sense. Others are bad companies dressed up as bargains. The discipline is in waiting for the right pitch and then swinging hard when it comes. Ted Williams, one of the greatest hitters in baseball history, divided his strike zone into 77 squares. He knew exactly which ones produced the highest batting averages, and he refused to swing at anything outside those. That's how we approach investing. We know our sweet spot. We know what kind of businesses we understand and what kind of prices make sense. And until one of those perfect pitches comes along, we simply wait. Our cash represents that waiting. It's not a sign of fear, it's a sign of discipline. Now people say, isn't that boring? Don't you feel like you're missing out? Not at all. I've learned over the years that the market will always give you another chance. It's like a bus that comes by every 10 minutes. You don't have to chase the one that's already gone. In fact, chasing buses and chasing stocks usually lead to the same result: exhaustion and disappointment. We prefer to sit still and let the right opportunity come to us. Our cash pile, then, is simply our store of patience. It's our ammunition for when the world loses its head. Because make no mistake, there will come a time when the market gets fearful again. It always does. That's when prices disconnect from value. That's when wonderful businesses get tossed aside because investors panic. And that's when having cash becomes the ultimate advantage. Let me give you an example. During the financial crisis of 2008, when the world's financial system was freezing up, Berkshire had cash and courage. We invested in Goldman Sachs and General Electric when they were desperate for capital. We were able to do it because we had prepared in advance. We didn't have to sell anything at fire sale prices or go begging to anyone for money. We could write the check instantly. That's the power of being ready when others are fearful. We made those deals on very favorable terms, not because we were lucky, but because we had been patient when others were greedy. Now, this idea of keeping a fortress balance sheet isn't new. It's simply the logical consequence of being responsible. Berkshire isn't a small partnership anymore. We are a massive enterprise with hundreds of billions in assets and over 360,000 employees. When you manage something of that scale, you can't think like a speculator. You must think like a steward. You must protect the foundation before you build higher. Cash gives us that protection. It ensures that no matter what happens in the economy, we can meet our obligations, pay our insurance claims, support our subsidiaries, and invest in opportunities when they arise. That's not idleness, that's prudence. Size also plays a role. We're no longer in a position where a small purchase moves the needle. Buying a $5 billion business, which would make headlines anywhere else, barely changes our overall results. To truly impact Berkshire, we need what I call elephants. Huge, high-quality businesses with durable advantages. Those don't come up for sale every day, and when they do, they're rarely cheap. So, until we find one that meets our standards at a sensible price, we prefer to wait. I'd rather earn a safe 5% in Treasury bills than chase a 7% return in something I don't fully understand or that's overpriced. The difference between 5 and 7 isn't worth losing sleep over, especially when one is risk-free and the other comes with uncertainty. Let's talk about that risk-free rate for a moment, because it's very relevant right now. For more than a decade after the global financial crisis, interest rates were near zero. That pushed everyone to take more risk. When you could earn nothing on cash, people felt forced to buy stocks, real estate, anything that promised a better return. That inflated asset prices across the board. Now, with rates back up around 5%, the equation has changed. That 5% is our hurdle. Any investment we make has to beat it after adjusting for risk, and most opportunities simply don't clear that bar at the moment. So we're content to hold Treasury bills. They're safe, liquid, and they pay us billions in interest while we wait. There's nothing wrong with being paid to be patient. People sometimes say cash loses value to inflation. That's true over the very long term, but cash also has an invisible value that doesn't show up on a balance sheet. Cash is an option to buy anything in the world at the right moment, instantly, with no restrictions. That optionality is priceless when the world turns upside down. When opportunities appear, we can act without hesitation. We don't have to borrow, sell assets, or ask anyone for permission. We can simply decide and execute. That's a strategic advantage that few can match. Let me take you back to another period in history that illustrates this point. In the late 1990s, during the dot-com bubble, we were sitting on a lot of cash. Technology stocks were soaring, and people said we were out of touch. They said the old rules didn't apply anymore. It was the new economy, and we just didn't understand it. They were right about one thing. We didn't understand those companies well enough to invest in them. The valuations made no sense. We didn't know how they'd make money, and we didn't pretend to. So we stayed out. We kept our cash. When the bubble burst and the NASDAQ fell more than 80%, we still had our capital intact. Many of those once hyped companies disappeared. And in the aftermath, we were able to buy wonderful businesses at great prices. The discipline to say no during the boom allowed us to say yes with conviction when the bust came. That's the value of patience. Our philosophy has never changed. We prefer to buy a wonderful company at a fair price rather than a fair company at a wonderful price. Right now, most wonderful companies are fully priced. They're not cheap enough to justify large investments. And fair companies, even at attractive prices, don't interest us much because over the long term, the quality of the business matters far more than the initial price. So our cash is a reflection of our standards. It says we will not compromise on quality or price just to be active. Activity for its own sake is the enemy of good returns. Cash also serves another crucial purpose. It protects our people and our promises. Berkshire is not just a collection of stocks. We own real businesses that employ hundreds of thousands of people, insure millions of customers, and serve communities across the globe. We have an obligation to ensure their security no matter what happens in the markets. If there's a massive natural disaster, a huge cyber event, or a financial shock, we must be able to meet every obligation without flinching. That's what our fortress balance sheet is for. It allows us to operate from a position of strength under all conditions. I often tell our shareholders that cash is not trash. Cash is the ability to say yes. It is the ability to survive. It is the foundation of flexibility. When others are forced to sell their best assets at the worst time, we can be the buyer. When others are cutting costs and panicking, we can invest. That difference in position comes entirely from the decision to be patient when times are easy. Now, I don't want you to think we hold cash because we're pessimistic. Quite the opposite. I've been optimistic about America my entire life. The system works. Innovation never stops. The country always finds a way forward. But even in a great country, markets swing between euphoria and despair. Our job is to stay rational in both conditions. We buy when others are fearful and sell or sit still when others are greedy. That simple rule has served us well for more than 60 years. Many investors struggle with patience because they feel they need to do something all the time. They look at the screen, see prices moving, and think they're missing opportunities. But the truth is, the big money is not made in the buying or selling. It's made in the waiting. You don't get paid for activity. You get paid for being right. And being right often requires long periods of doing nothing at all. Cash gives us peace of mind. It lets us think clearly. It keeps us from making impulsive decisions. It reminds us that opportunity comes to the prepared, not to the anxious. And right now, preparation means holding steady, collecting our interest, and being ready for the day when wonderful businesses go on sale again. When that day comes, we'll act. We may buy entire companies, or we may take huge positions in public ones, but when we act, we'll do it on a scale few can match. We'll do it with speed, with certainty, and with capital that was patiently earned and carefully guarded. That's the Berkshire way. Until then, we're content to wait. We don't mind earning 5% on $150 billion. It's a good return for sitting still. And while we wait, our businesses, from railroads and energy to insurance and ice cream, keep generating more cash to add to the pile. We measure success not by quarterly results, but by decades of compounding. We think like owners, not traders. Owners understand that sometimes the best decision is to let the field lie fallow until the right season. Traders can't do that. They're forced to act. We have the freedom to wait, and that freedom is worth billions. So when you see that big cash number, don't think of it as laziness. Think of it as discipline in visible form. It's the result of saying no hundreds of times so we can say yes once at the right moment. It's a sign of strength, not weakness. It's our margin of safety, our strategic advantage, our insurance policy, and our ticket to future growth, all rolled into one. If there's one lesson I want investors to remember, it's that you don't have to be constantly invested to succeed. Holding cash in expensive times is not a mistake. It's wisdom. It's what gives you the flexibility to seize opportunity when it knocks. Define your circle of competence, know what something is worth, and have the courage to walk away when the price doesn't make sense. Build your own reserve. It will give you not only safety, but also confidence. When fear sweeps the market, you'll be the one able to act. Having cash during a crisis is like having oxygen when you climb a mountain. You don't notice it when everything's fine, but when the air gets thin, it's the only thing that matters. The real key to wealth isn't constant motion. It's the patience to wait for those rare, obvious opportunities and the conviction to act decisively when they appear. At Berkshire, we're not in a hurry. We've been around a long time, and we plan to be around much longer. We know that markets will always swing, that fear and greed will always alternate, and that discipline will always be rewarded in the end. We're not market timers. We're business owners. And as owners, we understand that time is our friend. Compounding works quietly in the background while others chase noise. So yes, we're sitting on $150 billion, but we're also sitting on flexibility, strength, and patience. And when the world once again offers us bargains, we'll be ready. We won't show up with a thimble. We'll bring a wash tub, because when it's raining gold, the worst thing you can do is stand inside complaining about the weather. That is the philosophy behind our cash. It's not fear. It's preparation. It's not inactivity. It's intelligent waiting. It's the quiet confidence that comes from knowing that in the long run, the market rewards those who stay rational when others lose their heads. Our cash is not a problem to be solved. It's a weapon to be used at the right time. And when that time comes, we'll use it boldly, just as we always have. Until then, we'll keep doing what we've done best for more than half a century, staying patient, staying rational, and letting time work for us. So if you remember one thing from all this, remember this. In investing, the ability to do nothing when everyone else is doing something is one of the most important things, the most valuable skills you can develop. Cash is not a sign of indecision. It's a symbol of discipline. It's the visible proof of patience. And patience, over time, is what builds wealth.